Hello and welcome. Let's watch me fold some laundry awkwardly as we talk about 1099 expenses. If you're one of the lucky ones who gets a 1099, then you know at tax time it's that time to add up your expenses and see what your net income is and what the base is that you will be taxed on. Now, going through these expenses, especially if you didn't keep good records all year, is going to require you to go through all of your credit card statements, all of your bank statements, all of that little box of receipts that you shoved everything into all year, adding them all up, categorizing, and then there should be one final step. Taking a little step back and looking at the big picture. What I would challenge you to do is first compute your expense ratio. You're going to take total expenses and divide it by gross income. So your expense ratio is total expenses over gross income. For example, if your income is $100,000 and your expenses are $40,000, your expense ratio is $40,000. So think of it like your business lifestyle. A low ratio means for every dollar you get in, you're not spending a lot. You have low overhead. You are running lean or high profit. If you have a moderate expense ratio, usually about between 30 and 60%, is normal depending on the industry. And your industry is where you need to get specific. If you have an expense ratio of over 70%, that is a red flag. Because what we don't know is that there's no there's no expense ratio that's good for every industry. These expense ratios are going to be industry specific because there's different equipment, there's different everything that goes into different entities. So let's take a marketing director, for instance. The average expense ratio is about 50% for a marketing director. That's including travel, that's including meals, that's including LinkedIn subscriptions, that's including CRM platforms, and all of it that goes into your business can be deducted. A 1099, you're pretty much an entrepreneur. Think of yourself that way. Take control that way. And if you compute your expense ratio and you're too low, this is an opportunity for you to really take a step back, consult a CPA, and see what you might be missing. Also, it is important to keep in mind these expense ratios is how the IRS and state governmental agencies determine who gets audited. They run the numbers through computers in very efficient ways, and if the expense ratios are within the green light zone, then your return moves on scot-free. And if that return doesn't get audited in 3 years from the filing date or the due date, whatever's earlier, within those 3 years, you are good to go. Unless there's blatant fraud, they can't open up those years again. And, well, let's get to it. Coaches, it's often between 20 and 50%. Contractors, 40 and 70%. Online creators, 10 and 40%. You have to be specific and find out very specific expense ratios for your area and use that as a benchmark. And if your return does get chosen for audit, if that expense ratio is over the amount allowed and the return is red flagged, then you need to be able to support your expenses. You'll need to be able to document the majority of the deductions taken. But beyond what's in material, you're not going to need to support every dollar. Estimates are fine in some cases, and you really need to understand the numbers and understand what your liability needs to be so you don't pay any more.